Could Intel be bleeding billions, shedding thousands of jobs, yet still surprise us with a flicker of hope? This isn't just about quarterly numbers. It's about a tech titan, a true giant, fighting to redefine its very core. Intel, a name synonymous with silicon power for decades, recently announced its second quarter earnings, and the headlines certainly grab your attention. On one hand, the company defied market expectations by pulling in a solid $12.9 billion in revenue, handily beating the $11.9 billion analysts projected. That's a win, right? Well, not so fast. When you dig a little deeper, you discover Intel actually reported a net loss of $2.9 billion, translating to a 1 cent per share loss, completely missing the projected 10-cent per share profit. That's a stark contrast. A significant $800 million write-off on in-use production facilities really weighed down those earnings. It's like pouring money into a factory you just can't use. But here's where the plot thickens and Intel's story takes an unexpected turn. Despite those deep red numbers, under the leadership of their new CEO, Lip-Bu Tan, Intel is actually projecting a surprisingly optimistic outlook for the current third quarter. They expect revenue between $12.6 and $13.6 billion, more than analysts had anticipated, and they are even aiming for break-even on earnings. It's almost as if they're saying, we know it looks bad now, but just wait. So, how does a company bleeding billions suddenly find its optimism? Tan is not pulling any punches. He is implementing rigorous cost discipline across the board. Intel announced plans to cut 15% of its global workforce, a substantial move that will affect thousands of employees. They're also slowing down the ambitious fab expansion in Ohio and ending several projects in Germany and Poland. From now on, Intel will only greenlight new investments if clear customer contracts are already in place. This isn't just belt-tightening. It's a fundamental rethinking of how Intel operates. Think of it like a company going on a severe diet and intense workout regimen to regain its competitive edge. Looking at their performance across divisions, the Client Computing Group, which handles processors for our everyday laptops and desktops, actually performed strongly, bringing in $7.9 billion, exceeding its forecast. Their data center segment also showed resilience with $3.9 billion in revenue. However, the Foundry division, which manufactures chips for other companies, brought in $4.4 billion, but reported a staggering $3.17 billion operating loss. Clearly, some parts of Intel are thriving while others face significant challenges. The market's reaction to all this information has been, well, mixed. Intel stock initially saw a bump of about 3% in after-hours trading, but those gains quickly faded, dipping slightly into negative territory. Investors, it seems, are still wrestling with whether these drastic measures are the tough medicine Intel desperately needs or a sign of deeper underlying problems. So, as Intel navigates these turbulent waters under new leadership, we have to ask, will Tan's aggressive strategy truly pay off in the long run? Is this the painful but necessary transformation that will allow Intel to reclaim its past glory? Or is it merely a temporary bandage on a much larger wound? We want to hear what you think. Head over to our website or social media and share your thoughts.